This question examines the application of learning curve analysis in cost estimation and production planning. The company is preparing a bid for a special order of 80 units, and the production manager expects that direct labor hours per unit will decline by a constant percentage as cumulative production doubles. This pattern reflects the learning effect, where workers become more efficient through repetition and experience. The key phrase in the question is, direct labor hours per unit will decline by a constant percentage each time the cumulative quantity of units produced doubles. This statement is the classic definition of a learning curve. Learning curve analysis is particularly useful when producing new or technically complex products because employees improve their skills over time, reducing labor hours and production costs. Managers use this technique for pricing special orders, budgeting, forecasting labor costs, and planning production schedules. A. Cost-profit volume, CVP, analysis. Incorrect. CVP analysis examines the relationships among sales volume, costs, and profit to determine break-even points and profitability. It does not analyze labor efficiency improvements resulting from experience. B. The Markov process. Incorrect. A Markov process is a probability model used to analyze transitions between different states over time. It is unrelated to estimating labor hours based on production experience. C. Linear programming analysis. Incorrect. Linear programming is an optimization technique used to allocate limited resources efficiently. It does not measure productivity gains from repeated production. D. Learning curve analysis. Correct. Learning curve analysis estimates how labor hours decline as cumulative production increases, assuming a constant percentage reduction whenever output doubles. It is widely used in manufacturing, aerospace, construction, and other industries producing complex products. Correct answer. D. Learning curve analysis. Exam tip. Whenever an exam question mentions labor hours decrease with experience, efficiency improves over time, or time declines each time cumulative production doubles, the appropriate technique is learning curve analysis. It helps managers estimate labor costs, prepare competitive bids, and improve production planning by incorporating expected productivity gains from accumulated experience. This question tests understanding of the limitations of the traditional budgeting process. Traditional budgeting has long been used for planning, resource allocation, and performance evaluation, but it has also been criticized for being time-consuming, inflexible, and overly focused on short-term financial targets. Modern management approaches, such as rolling forecasts, balanced scorecards, and beyond budgeting, were developed partly to overcome these weaknesses. The key word in the question is except, meaning students must identify the statement that is not a criticism of traditional budgeting. In other words, 3 choices describe recognized weaknesses of traditional budgeting, while 1 choice describes a feature that traditional budgeting generally does not possess. Students should remember that traditional budgets are primarily financial documents and typically place less emphasis on non-financial performance measures, such as customer satisfaction, quality improvement, innovation, or employee development. It makes across-the-board cuts when early budget iterations show that planned expenses are too high. Incorrect. This is a common criticism of traditional budgeting. Uniform budget cuts may ignore strategic priorities and reduce spending in areas that create long-term value. B. Incorporates non-financial measures as well as financial measures into its output. Correct. This is not a criticism because traditional budgeting generally focuses on financial measures, such as revenues, costs, and profits. The incorporation of non-financial measures is a characteristic of more modern performance management systems, such as the balanced scorecard, rather than traditional budgeting. C. Overemphasizes a fixed time horizon, such as 1 year. Incorrect. Traditional budgets often use an annual planning cycle, making them less flexible in responding to changing business conditions. D. Is not used until the end of the budget period to evaluate performance. Incorrect. Traditional budgets are often criticized because performance evaluation tends to focus on end-of-period comparisons, rather than continuous monitoring and adaptive planning. Correct answer. B. Incorporates non-financial measures as well as financial measures into its output. Exam tip. Common criticisms of traditional budgeting include fixed annual planning horizon, emphasis on short-term financial targets, slow response to environmental changes, time-consuming preparation process, across-the-board cost reductions, limited support for continuous improvement. In contrast, modern budgeting and performance management systems incorporate both financial and non-financial measures, making choice B the exception. This question tests understanding of the budget preparation sequence within the master budgeting process. A master budget consists of a series of interrelated budgets that must be prepared in a logical order because later budgets depend on information generated by earlier budgets. Understanding this sequence is essential for management accounting, financial planning, and budgeting examinations. The key phrase is correct chronological order of preparation. Students should recognize that budgets are prepared by following the flow of business operations. First, managers estimate production requirements, then determine the materials or purchases needed to support production, followed by the calculation of production costs and cost of goods sold. Administrative expenses are typically budgeted after operating budgets have been established because they are not directly tied to manufacturing activity. The budgets listed are I. Cost of goods sold budget II. Production budget 3. Purchases budget IV. Administrative budget. Step 1. Production budget 2. The production budget determines how many units must be produced to satisfy expected sales and desired inventory levels. It serves as the foundation for subsequent manufacturing budgets. Step 2. Purchases budget 3. Once production requirements are known, the company prepares the purchases, or direct materials purchases, budget to determine how much material must be purchased to support planned production. Step 3. Cost of goods sold budget I. After production and purchasing costs have been determined, management can estimate the cost of goods sold, COGS, using production cost information. Step 4. Administrative budget 4. The administrative budget estimates selling and administrative expenses, which are generally prepared after the major operating budgets and are separate from manufacturing costs. Evaluation of choices. A. 1, 2, 3, 4. Incorrect. Cost of goods sold cannot be prepared before production and purchasing budgets. B. 3, 2, 4, I. Incorrect. Purchases depend on production requirements, so production must come first. C. 4, 2, 3, I. Incorrect. Administrative expenses are not the starting point of the budgeting process. D. 2, 3, I, 4. Correct. The company first determines production requirements, then material purchases, then calculates cost of goods sold, and finally prepares the administrative budget. Correct answer. D. 2, 3, I, 4. Exam tip. A simplified budgeting sequence is sales budget production budget direct materials purchases budget direct labor budget manufacturing overhead budget cost of goods sold budget selling and administrative budget cash budget and budgeted financial statements.